Statistically speaking, December is one of the worst months of the entire year to day trade for the average retail day trader. That doesn't mean you can't trade successfully in December, but there are some things that are very important that you need to keep in mind. If you think about the holiday season and December and the end of the year, you need to think about what's going on in the entire world, primarily based on the United States habits. Many people like to take their vacation days in December to take advantage of the holiday season, spend time with families, so there are less people working. There are also national bank holidays, meaning that there are specific days off this year that banks are closed. Most of the transactions that are done in day trading and the Forex industry are going to be through major financial institutions like banks. Due to those two things, less people trading in the market because they're taking time off for the holidays, more days that banks are closed in the month of December means lower than normal volume. Lower than normal volume means your strategy that you've been trading all year may not work as anticipated, especially if you're a breakout trader and you're looking for breakouts of specific support and resistance zones. The volume won't be there to take advantage of that breakout. The next and most important thing of all of December is a term called tax loss harvesting. This is what people do to balance out their books at the end of the year. Now, let's say you bought two stocks at the beginning of the year. This can be two different asset classes, two of the same industry, it does not matter. What you're looking for here is balance. Let's say that you bought a bunch of Facebook stock at the beginning of the year, and all year it's just been cascading down. And on the other hand, you bought Nvidia and all year it's been going up. What a lot of people do is sell off their losing position of the losing asset, for example, Facebook, and take the loss on book and then use that loss as a tax deduction for all of the profits that they made in other things, whether it was real estate, whether it was day trading. So let's say in the whole year, you made $100,000 in profit, but your one bad position on Facebook took a monstrous loss of, let's say, 60K, you can offset the 100K with the 60K loss and pay less taxes on the 100K that you made. This is a very deep topic, and there are different legalities about specific assets and what you can buy and sell at any given time in that time frame. But essentially what people do, not a recommendation, is sell off that losing position of Facebook, take the loss on paper, and then buy it right back in anticipation that it's going to go in the general direction that you originally anticipated, which is up. So you only took the loss on paper, but you still hold the asset after the taxes are filed. The end of the year is all about balancing the books. So there will be periods of monstrous volatility, especially when fourth quarter earnings reports come in, because fourth quarter spending is the most insane. All companies have advertising budgets. Those advertising budgets have very little spend throughout the year, and then at the end of the year, they already have allocated that amount of money for advertising spend. So that's why you see ad revenues on YouTube going up. You're getting 3 or 4 unskippable commercials on YouTube. All of it is directed at consumerism and people spending their money, so they know that this is the time of the year that people spend their money, so they will spend all of their advertising spend budget in this month. The YouTube revenue on this channel goes up 100% just in the month of December. I make the same amount of videos, it's just advertisers are willing to spend more money now. And also companies like Amazon that take full advantage of the holiday season, their revenues increase during this time, showing a spike in their profits, causing their stock to go up. Thus, you start seeing the volatility spikes towards the end of December. There's also another term called the Santa Claus rally. Basically, certain assets will rally right after Christmas, essentially between Christmas and just after New Year's. You will see some assets just spike massively. Lots of volume, lots of movement, lots of good profits, and this is why a majority of day traders simply take this month off. I'm not saying that day trading won't work in December. There's a lot of people that do it. I choose not to because 90% of the time it's like trading right before London session, right? There's like tiny little candles and little minute movements, and it's very slow moving. And that's a majority of what your day trading looks like in December, except for those few times where earnings reports come out, you've seen some huge, massive volatility because of the tax loss harvesting. And so you'll be in a position that's moving really, really slow in anticipation it's gonna, and then it just does this for 15 minutes, and then it goes back to normal. Unless you have done December before successfully, or you've practiced it, or you've back tested it, I would recommend not trading in December. It usually causes a lot of heartache. So what should you do instead? The same thing as everybody else. Spend time with family, relax, unwind, have a period of self-reflection of everything that happened this year, and write down what improvements you'd like to make to yourself next year. If one of those improvements may by chance be becoming more educated in day trading and getting better at it for next year, you can sign up to the trading floor. You could take advantage of this downtime and spend your time with your nose buried in the books, PDF files, and educational videos. Prepare yourself for January. Because most of the trading industry does take a break during this time of the year, what we like to do inside of the trading floor is an advent calendar. And if you don't know what that is, it's one of these things. So they're usually filled with chocolates. This one in particular is filled with Lego figurines. Side note, I'm quite excited about this little holiday Ewok. But essentially from now, December 1st until December 25th, each day you get to open up a box and get a little present. We do the same thing for all of the members in the community. This year we have a ton of amazing gifts. So I'm gonna list off a couple of them for you. a $100 Amazon gift card, free yearly membership, a 9th gen Apple iPad, a portable computer monitor so you can trade on the go. If you're a day trader, you've heard of Magic Keys, so we're giving away a physical Magic Keys, a $25,000 prop firm account challenge, some Apple AirPods. Like, this entire calendar is jam-packed. Not only that, we have a bunch of merch that we're giving away, and on the days that we give away merch, with that merch, you also get a free one-on-one call with either me or one of our staff members. The one-on-one call with me is given away on December 3rd. So I would highly suggest taking this time to get educated, sign up, take advantage of all the free gifts we're giving away the entire month. And if you sign up today, there's a high likelihood you could win that one-on-one call with me. So at the end of the day, should you trade in December? If it's something you're used to, go for it. You know what to expect. I don't have to tell you what to do. If you are new, however, it might be a bad idea for the reasons I listed earlier. But if you'd like to try it out without any risk whatsoever, trade December with a demo account. Continue your practice, continue the repetitions, just do it safely with zero risk on a demo account. That way, if anything goes wrong, it won't hurt you. And if it goes right, you'll know what to do next December. If you guys enjoyed this video, all I ask in return is quickly share this video with somebody you like. Thanks so much for watching, and we'll see you in the next one.